Welcome to capstrat this week. Will Woodall, joined as always by Mike Rarey. Hey, Mike.
Hey, Will.
It is July.
It is.
So we're going to take a look back at the first half of the year, look at returns for the year through June 30th here, and talk a little bit about what's happening in the market, give an update on our framework, and talk a little bit about, we've had some things happen just recently. Fed speak, looks like for sure more rate hikes are coming. We had a pretty big blowout jobs number that we'll probably not talk about in detail today, but we can talk a little bit about. And we've got such an interesting look at the returns for the first 6 months of the year and how they've been impacted by just 7 stocks. So let's first look at the equity returns, throw them on the board.
Yeah, and we'll focus on those large cap stocks and year to date. And as you said, this video shoot will sort of be like a narrative of everything that's happened throughout the first 6 months and what we think. And you look at large cap stocks year to date up 16.9%. That index there is the S&P 500. Large value stocks up 5, large growth stocks up 29. And of course, at first glance, you would think, what an incredible broad market rally, right?
No.
But that's certainly not the case.
Yeah, certainly is not.
So if you dig under the hood, and we've talked about this quite a bit, how top heavy the market's been, you look at the top 7 contributing stocks to that S&P 500 return. These 7 companies, NVIDIA, Apple, Microsoft, Meta, Tesla, Amazon, and Alphabet, they have now been coined the Magnificent Seven.
Yeah.
We did not come up with that.
I don't like it.
I think Jim Cramer is getting credit for it, which is fine. But we've done a lot of math here, so we'll sort of, highlight what's important. And the point is, these 7 stocks, in aggregate in the S&P 500, they're up about 66%, but they represent over 23% of the index because, of course, it's market cap weighted and these are big companies. So you do the math. If in the S&P 500 they're up 66, they represent almost a quarter of the index. They contribute 15.4% of the index's 16.9% return. So pretty much everything. All the other stocks in the index, the other approximately 493, are up 1.9%. So basically haven't gone anywhere.
Right. And I think what's of note, you put $1 in the index, 23 cents of it goes into these 7 stocks, right? And these weights are growing rapidly. So just talking about the weights of these 2 stocks in particular. Almost 7% for Apple, 6% for Microsoft. When did these become problematic from an indexing perspective?
Pretty soon, actually. We got to this point around 2020, I believe fall 2020, but we're once again getting towards the point where if you buy an S&P 500 index, or certainly a large growth index, per SEC's definition, this large growth index where these 7 stocks represent 39% of the index, you cannot call that index fund a diversified investment.
Right.
We're not quite there on the S&P 500, but we're getting close.
So what's interesting about that is that impacts behaviorally what investment managers can and can't do in their portfolios. There's a lot of managers who can't put that kind of weight in Apple or Microsoft. So theoretically, one of the reasons NVIDIA shot up is a lot of managers, to get exposure to the tech side, have been looking for something that has a lower weight. NVIDIA has a lower weight. That's prompted some of that purchasing in NVIDIA because they can't buy Apple.
Right.
But just in general, like why these 7 stocks?
I mean, well, AI, and then who's going to benefit from AI, and then you throw in Tesla. I mean, these are the same 7. There's been a rotating list of, say, 5 to 10 stocks, and they're all FANG Plus. Netflix used to be in there, whatever.
The names, right?
That have been top heavy like this for a while. This is just a very extreme example. This is probably the most top heavy period we've seen for these names year to date. And we've had clients say, "Oh, well, I need to own more of these stocks," or "Why don't I own these stocks?" You do. If you own a large growth fund, about 40 cents of every dollar goes in these stocks. Right. If you own an S&P 500 fund, about a quarter of every dollar goes into these stocks. So People own them.
Yeah. If you just look at flows into index funds, right? The S&P 500 index funds, every dollar that goes in, 13 cents goes to those two stocks.
Mm-hmm. Yeah.
So they're just getting fed constantly.
So yeah, it's a very unique environment. These are all very expensive right now.
Mm-hmm.
They're expensive relative to earnings. They're expensive relative to their own history. They're expensive. They're really expensive relative to cash. So that's the concern.
All-time highs, right? I mean, Nvidia, Apple, Microsoft, all-time highs.
Yeah.
Stock price has never been higher. Only one place you can go. Higher, right?
Higher. I was about to say, don't say lower.
Yeah. So it's interesting. Just something to be aware of as you're looking at your performance for the year. If you don't own these stocks at the weights that the index owns them, you're obviously underperforming the index.
Mm-hmm.
If you do own these stocks at the weights, you're doing well. If you own them above the weights, you're killing it.
The few, the proud, I guess.
Right? Yeah.
Yeah.
Okay. Let's move on to fixed income. Wasn't quite as rosy of a start to the year for fixed income.
Yeah, fixed income performed very well first part of the year, and then right after all the banking turmoil in March, bond yields came down quite a bit, even though the Fed kept hiking short-term rates. And then since then, which is what we'll get into in the rest of the narrative, the Fed started to get the market to price in more rate hikes. They continued hiking even after the banking turmoil, and so bond yields have come up a little bit quarter to date and then in June as well. But still a very nice recovery compared to what happened last year. And since last October, when inflation shifted to high and falling, bonds have done very well really across the board. So.
Yeah. And so what's missing from here is the return on cash, which is currently above 5%.
The yield is 5. So year to date, if you own T-bills, you've got about 2.3. Yeah.
So cash as an asset class becoming more and more attractive.
Oh, yes, for sure. Most attractive it's been since before the tech bubble burst or in 2007.
And with 2 more rate hikes coming.
Yep, it's going to get even better.
Even better. All right, let's move on to alts because it was sort of a mixed picture here.
Yeah, and the big story year to date is commodities down almost 8%. And then looking at the types of commodities that are doing well, if you look at industrial metals versus precious metals, that's probably sort of the biggest pair trade, if you will, because industrial metals, things like copper, are very sensitive to global economic expectations. And you'll see industrial metals down 12% year to date, versus precious metals are typically the opposite. You have things like gold in there. That's sort of a safe haven, and those you can see up. So if you look at something like copper-gold ratio, it's down tremendously, meaning copper has underperformed gold quite a bit here year to date, which is, one component within our broader recession signal.
Yeah, I mean, it's a huge indicator, highly correlates to recession. And it's not something unexpected. Okay. Let's give an update to our framework, starting with economic growth.
We said coming into this year, if you look at economic growth expectations 1 year out, they're roughly flat. And the point was that is exactly what the Fed wants. If they can get economic growth as close to zero but positive as possible, that's a win. And the other key thing here is there were upside risk, meaning if growth came in hotter than expected or better than expected, that could be a problem. And then obviously if growth came in worse than expected, that would be a problem. And so what sort of transpired here year to date, particularly in June, is growth has been surprising to the upside. You look at economic data like, for example, housing starts significantly beat expectations. Anything related to services, the propensity for the consumer to spend their savings on services and continue to, spend money on services using debt has been shocking. It has exceeded expectations. And then the labor market numbers keep coming in hot. So how that shows up on this chart is this little dashed line right at the beginning of the dashed part is a little higher than it was. That's all it is. 1 year out, the outlook isn't that different, but this economic data being more resilient than expected actually had significant implications for the Fed, inflation, liquidity, et cetera, and it's really going to shape the outlook for the back half of the year.
And what in particular is the Fed focusing on in terms of economic growth? Like when do they say, oh boy, we need to change course here?
Yeah. So, they would be fine with economic growth if it didn't result in continued stubbornly high inflation and wage growth and things like that. So what's a problem for them is the services, the spending on services coming in so hot.
Yeah.
And that's why they feel like they need to continue to hike. And then when they would stop, when they would start looking at cutting, would be evidence that you're seeing layoffs in the services sector, things like leisure, hospitality, those wage-intensive industries. Those are sort of the two trigger points. Mm-hmm. If services X housing is hot, then we need to keep hiking. If labor in that area is weak, then maybe we can stop and maybe we can cut.
And does the Fed care more about the level of unemployment versus the rate of change of unemployment?
Well, in this cycle, they probably are going to care about the level. In prior cycles, they probably care more about the rate of change. Yeah. The reason for that is they have a dual mandate, price stability and full employment. In this cycle, those things are at direct odds. So they're willing probably to see some level of increase in unemployment in order to achieve their price stability goal. In past cycles, price stability wasn't a problem. It was a one-sided mandate. So if there's any increase in unemployment, they're just going to cut. And that's not going to be the case this time around.
Yeah. Okay. All right. Let's move on to inflation.
It's almost imperceptible, but basically what the positive economic surprise recently has done to these inflation figures is it's made them much more sticky, stubborn, if you will.
Yeah.
And on the margins, sort of 12 months out, our forecasts for headline and core have come up. So yeah, you circle headline first, and you'll see the June print that we're going to get coming here mid-July. It's going to show continued disinflation or deceleration. But that's due to base effects. From there, over the next 12 months, no progress, going sideways. And the Fed has models too, right? They see this. That's why they're coming out and talking more hawkishly, saying we need to do more. They're saying, hey, the easy money's done, right? So that was the easy part, getting inflation down to these levels. Now's the hard part, where we're worried about things like wage price spirals. And 12 months out, looking at core CPI, in May, when economic growth was a little slower than expected, we were seeing that start to creep below 4, into like 3.8 it even got down to. And now it's come back up above 4, which is, of course, twice their target. So this is where this happened a little bit during February, but this is where good news becomes bad news. And now we're more focused on, do we have to go through another hiking and tightening cycle in order to feel confident that we're going to achieve price stability?
Yeah. So, yeah, I mean, this would suggest there's more room for them to raise rates.
Yep, for sure.
So let's take that to the Fed funds futures curve and talk about how that has changed. And why do maybe just first, why do we show this to people? Why are we showing this to the viewers?
Because it's fun. No, this is extremely important because how these lines...
Fun.
Exactly. We put the fun in it. No, because how these lines evolve, you can start to see, what the market's pricing in, what's fair value, et cetera, what's baked into consensus. And so this green line, and the other reason is because the market leads the Fed, not the other way around. So if the Fed is pricing in hikes...
Does Jay Powell believe that?
Actions speak louder than words. His actions suggest he does believe that. But if the market is pricing in hikes, the Fed's going to follow with hikes. So basically why we're showing this is on March 15th, peak banking crisis moment, right? Silicon Valley and Signature Bank failing. The December 2023 Fed funds future contract implied that at the end of this year, the Fed funds rate would be at 3.89%. So that's significant cuts, right? And that was a big reason why we got a rally post-banking crisis. Because it was, hey, I'm not worried about this. The Fed's going to respond. They're going to provide liquidity, buy the dip, get ahead of that. That has gone away and some. Now we're sitting here at the end of June, and that same December 2023 Fed funds futures contract is at 5.4. So pricing in multiple rate hikes. And the delta here is huge, right? 1.5%. roughly. 6 rate hikes difference transpiring over about a 3-month time period in terms of expectations.
Yeah.
So if that's why stocks were rallying because cuts were coming, then it's difficult to say that they should still be rallying because the cuts are totally gone.
Right.
I mean, even if you go out to 2024, the end of the chart is the end of 2024.
Yeah.
This is just higher for longer.
Yeah.
You know, big delta, over a 1% delta between what the market expected in March versus now. So now the market is saying, Fed, you cannot stop. I know you paused at the last meeting and you sort of gave us a head fake and led us to believe that it was unanimous to not hike. When you read the minutes, clearly that was not the case.
Right.
But you need to keep hiking.
Yeah. I mean, we're clearly above 5 for another year.
Yeah.
Which, talk about the impact that has on businesses, because it's becoming, every day it's becoming more difficult to operate when financing and rates are this high.
Yeah.
I mean, we're seeing it with clients with margin loans,
Yeah.
all sorts of other variable rate loans that are starting to roll over and going from 3.5% to 12.5%.
Yeah.
Or higher in some cases.
Yeah. Any loan that you have with a floating rate, the impact is, you know, it's pretty easy to see. It's just slapping you right in the face. But the other impact is, say, take it from the stance of a high yield borrower. So you're a high yield company. In 2020, interest rates are at 0. So you refi your debt. You push out your maturity wall. That's good CFOing, right? So now you refinance. You have a 5% rate on your bonds, and it doesn't mature till 2027. Well, when we're down here in green, nobody's worried about you being able to refinance that debt at a reasonable rate in 2025, right? If you're due 2027, you're probably going to refi 2025, thereabouts, you know, if you know what you're doing. But now, if this continues, now the market is saying, well, you may refi, but it's not going to be at a good rate. It's going to be a rate that's actually going to be a big problem for your business. So that's the other impact that's sort of less understood or you know, front of mind for a lot of folks is every single company that pushed out their maturity wall and is hoping they can just extend and pretend, that's going to be harder and harder to do the longer these rates are at these levels.
Right. Yeah. I mean, even if this forecast does come true, you take another 6 months out, you're still well above 4.
Right.
Which is very difficult for these companies.
Yep.
Okay. All right. So let's move to liquidity.
Yep. So, you know, these things directly related. What does higher rates for longer do to liquidity? It makes it worse for longer.
Yep.
So, you know, we're still steeply negative, basically for the next 10 months or so.
Yeah.
Negative year-over-year money supply growth. It's going to be very difficult. And we just talked about the impact that a higher Fed funds rate has on the real economy and businesses and financing. The impact on asset prices is the next impact that we want to sort of show out, and earnings, things like that. This liquidity environment, markets have detached from liquidity reality just the past few months.
Yeah.
And they reserve the right to do so at any given time. But liquidity matters eventually. Usually it matters quicker than this, but it does matter.
Maybe before we go on, just explain, so we really haven't seen liquidity blow out based on the replenishment of the TGA yet.
Yeah.
So it's sort of been mild. The reverse repo sucked up most of it. Is that right?
Yeah.
What do we see as potential for that going forward?
Well, you still have approximately $200 billion of TGA to build, and you know, hopefully reverse repo sucks all that up. But even if you say best case scenario, reverse repo sucks up all the TGA, you still have the Fed decreasing the size of their balance sheet by $95 billion a month. So it's still going down.
So it's still going down.
And so that's all reflected in our net liquidity forecast as well.
Not as fast as we thought it might, perhaps?
Yeah, I mean, pretty close, because we were very conservative
in our estimate.
In our initial estimates, so it's pretty similar.
So let's look at the stock prices versus central bank assets.
Yeah, where we start to look at the detachment that we're seeing now. So, you know, everything that's happened, economic growth here recently, a little better than expected, means the Fed has to keep rates higher for longer. What does that mean? Well, if you look at stock prices versus central bank assets, we have a big detachment here. And we looked at central bank balance sheets in aggregate before they had just started to roll over. Now they're really rolling over. Mm-hmm. And now the conversation is, does the Fed need to go to 6? Does the Bank of England need to go to 7? Where does the ECB need to go? Mm-hmm. It's that we can't stop hiking. So once again, the R squared here is about 0.95, 0.94, something like that. So it's about as good as it gets.
This is another time we had detachment.
Yeah, yeah. So this was an interesting time of detachment for a couple of reasons. One is central bank assets weren't going down, they were going sideways. 2, fiscal stimulus was doing the lifting, mm-hmm. right?
Yeah, right.
So we don't see fiscal stimulus doing the lifting going forward, and central bank assets aren't going sideways, they're going down.
Yeah, I mean, it just took time for it to catch up, to go from here
right.
to here.
Right.
Which is what we're trying to protect against, right?
Yeah. So there's a big disconnect there.
Okay.
And then in net liquidity, and this is something we've talked about before, still a big disconnect. You see now net liquidity rolling over, even though reverse repo has soaked up a good chunk of the TGA. And, you know, our forecast still being conservative out through the end of September, a lot of this decline in net liquidity now is not coming from rebuilding the TGA. It's just coming from the Fed rolling off their balance sheet. Mm-hmm. And the expectation that we're not going to get another round of heavy loan issuance due to combat a banking crisis or something like that. So right. If just sort of all goes as planned, net liquidity implied fair value for the S&P at the end of September is like 3250, which don't know if that'll be right, but directionally you see we've detached quite a bit.
Directionally, we need to come down.
Yeah.
Because there's not a lot of evidence that this line is going to get pushed up.
Yeah. It would take a pivot.
Right.
Which that is not how they're talking.
And as we just talked about, we've got at least a year at 5+% Fed funds rates. Mm-hmm. At least a year.
Yeah.
So the pressure on this to go back up,
it'd be tough.
It's not there.
Yeah.
It's not there. Yeah. So do we have any, we probably don't, I'm going to put Mike on the spot here, but do we have any historical data on this gap, the width of it, how it compares to other periods, and what the closing percentages look like?
So if you looked at something like reverse repo, TGA, and Fed asset, well, take reverse repo and TGA, before 2020, they're nothing charts. So this is really the only time this has mattered. Before that, it was basically Fed assets, mm-hmm. which we know the relationship between Fed assets and stock prices. We showed it on the prior slide. This is just a more nuanced view based on the vehicles that are in existence
Shorter
today.
Time period.
Yeah.
Cool. What's the correlation of this?
This is like 0.9.
0.9.
Yeah. So.
Cool. Okay.
So we're detaching there.
Detaching there, and then earnings.
Yeah, and so that's the other thing, stocks versus earnings.
Earnings just looked awful last week.
Year-over-year change of forward earnings expectations for the S&P is that light blue line. They're down 1.7% year over year, versus the S&P is up 17.5, 17.6. So that's another detachment that we're seeing. Are earnings going to catch up? If they are, it looks like it's not going to happen until Q4 or even calendar Q1 of next year, if it happens. Yeah. And very recently here, despite the economic growth data in June coming in better than expected, earnings revisions for the coming earnings season have been coming down.
Yeah.
So by all accounts, this is going to be another quarter where the expectations are very low and companies need to beat. And they really need to beat now, right? Coming into Q2, stock prices were low, so even if you didn't beat, you probably didn't get hurt that bad. Right. Now, stocks are priced very optimistic scenario. A soft landing, earnings rebound, no recession type scenario. So that has to happen to justify where we're at. Mm-hmm. It's a much different starting point than where we were at the beginning of the year, where it was basically like if you avoid recession and you get a little net liquidity boost, maybe we could get positive returns for equities. It's much different now.
Right.
It's a higher bar.
Yeah. I mean, I think we've seen like 16 companies report for Q2, and they were awful. I mean, it's only 16, but not good. So we'll keep you posted on that. And then Tina. Yeah,
TIA. There is alternative. So this is
now a TIA.
It's the last thing looking at these are all different ways to show our stock's fairly valued relative to fundamentals, and each one of them is showing no by a large margin. And this is the last one where you take the S&P 500 is at about 19 times forward earnings. So you put that into an earnings yield. It's a little over 5%. Just take the inverse. So 5.29, and that is below the yield on 6-month Treasury bills. Mm-hmm. So that does not happen often. The difference between those two numbers is called the equity risk premium. It should be positive because you're taking on more risk to invest in equities than you are investing in a 6-month Treasury bill.
Right.
You should get a premium for that.
Yep.
You do not. You no longer get a premium. And if you had a strategy of buying stocks every time the equity risk premium was negative, you would be out of money. That's a very bad idea. You could get a risk-free 5.5.
Right.
I mean, we're talking, there's almost no duration in a 6-month Treasury bill.
Right.
Risk-free 5.5 versus a basket of stocks that's totally detached from everything we just looked at. It's slapping people in the face.
Yeah.
But
sure is. Okay, let's move on to recession signals. Mm-hmm. Talk maybe first about the increase in weekly jobless claims we're seeing, and contrast that with this. Who knows if it's a real number or not? This jobs report we got this morning.
The ADP number.
Yeah.
So within our composite recession signal, there's the labor market signal. It's based on initial jobless claims. You take the 12-week moving average, percentage increase from the 52-week low. We're up 21.8% based on the jobless claims that were released today. We're shooting on a Thursday. So where does that stand? That's in the warning zone. When they're up 25%, that has resulted in a recession every single time. And it's a coincident indicator, meaning once that happens, you are in the recession.
It's the dangers. We're going to call it the danger zone.
Call it the danger zone.
I watched Top Gun this weekend, so.
Okay, that's fair. So we are flying right into the danger zone.
Right in the danger zone.
And you asked a question during our last shoot, how could this time be different? How could this be wrong? And in theory, what could happen is, people are filing initial jobless claims. People are getting laid off, but they're just turning around and finding jobs again. And so it would not have a recessionary impact. You just have a lot of churn within the labor market. And so you would need to corroborate the initial jobless claims data with continuing claims.
Right.
And so that's what we've done here. And that's the red line. And it's past the danger zone, if you will. It's approaching peak recession territory. But you'll notice just the last couple of weeks, it's hooking down. So this is extremely interesting, okay? And then you take this where you see clearly some people are now losing their jobs, right?
Yeah.
But people that have been out of work are getting jobs.
Yeah.
And then you look at the ADP report today, which says private sector payrolls in June up almost 500,000. And you look under the hood, and almost half of that is just leisure and hospitality. But we have negatives within some sectors. So manufacturing actually losing jobs. It's been a long time since manufacturing companies felt comfortable decreasing their headcount, right? Anything related to information technology, business services, financial services, all those service sort of white collar type industries, we're actually seeing negatives. So what's happening here? Early on in the year when we got those big payroll prints, no jobs are being lost.
Right.
Now, clearly, people are losing their jobs. But the services, the leisure and hospitality sector is picking up. It's sort of catching up in terms of the jobs recovery. And that might be sort of the last hurrah, because clearly the services sector started to add payrolls quicker coming out of the pandemic.
Yeah.
Right? So, talking about business services and things like that, manufacturing, et cetera.
Yep.
They added payrolls quicker, and they overhired. Now they're starting to reduce. And leisure, hospitality, those types of services industries were slower to add payrolls because of the pandemic.
Yep.
And now they're catching up, and they've almost already caught up. They're almost at full employment.
Yeah. Catching up when things are just about to slow down.
Right? So, we say it every time. It's going to be very interesting to watch and see what happens. I would go out on a limb and say the non-farm payroll report tomorrow is going to be positive. But the key will be in the details.
Right. Yeah, exactly. Yeah. And what carries more weight with the Fed, the employment reports or the non-farm or the weekly jobless claims?
Well, that's tough to say. Tough to say. I mean, it looks like they're focusing a lot on, like if you read the meeting minutes, they're focusing a lot on coincident lagging data.
Yeah.
So it's clear that they put a lot in the non-farm payroll report and the household survey. They are not great predictors of recession, though. Weekly jobless claims are way better.
Yeah.
So.
Okay. Well, that's it for this week. Appreciate you tuning in. If you have any questions, as always, let us know. And have a great week.